What's up, my friends? Happy Monday to you. Going to cover several things today. This week, the weekends are always interesting times to really see what people are thinking about. People slow down from the week, and so got a lot of questions this weekend. Had a lot of things coming in. Want to discuss some of these things. Want to go through some of the charts. We're going to talk about mortgage rates. We're going to talk about inflation pressures. We're going to talk about recession fears. We're going to talk about have we reached the top in housing? Are interest rates going up enough that it's going to actually cause home prices to come down? We have not seen any evidence of this yet, but it's what a lot of people are talking about. In fact, I've been polling people, just individuals who have listings, and they're saying, they're talking about the quality of their offers. Some of them have said that they're getting less offers than they had before, but still very high quality offers. Sellers not really suffering anything yet. Still getting way above list, still dictating terms. So we don't have any real reason to talk about this, as then a lot of people are talking about it. And that's okay. That's okay. It's always good to be on the lookout, talk about time frames. As I've discussed before, when you get the early signs of stuff like this, even if it plays out, it could take years to play out. And we'll show you on some of the data here what that looks like. So Derrick Evans here, VA Home Loan Specialist, NMLS 155010. You can call, you can text me if you want to buy or if you want to refi. You can email me as well. Let's dive into this. Let me get this out of here. And let me get myself out of here.
Check, please.
All right. I'm going to start here because I think, there's definitely a lot of recession talk going on out there. And there's a few things. There's a few things that do point to that. And we're going to talk about those things. We're not going to ignore any of this stuff. We're just going to see, ultimately what happens, of course, is not up to our charts or what we think. But at the end of the day, we should be prepared for all options, right? You look at mortgage rates here. This is 30-year fixed mortgage rates, and this is all information that's coming from the Fed, the Federal Reserve. So they're two different charts just laid on top of one another. That's all this is. And you look at the 30-year fixed average mortgage rates, which includes all programs, okay? And when you look at these rates, I got a pretty thick line there, guys. You see a few things. Here was a key support resistance area. Here seems to be another one-ish in there. We haven't gotten to that yet. But overall, you can see rates have been heading down. They've been going down for a long, long time. I mean, this is going back to the 1980s. So rates have been going down for a long time. And when you see a spike like this, it's kind of like, whoa, look at the trajectory of that thing. Just straight up. Crazy. Like onto a cliff, I guess. And, it looks scary. But if you look at what's really happening here, it sure appears as though we are just simply going to go back into this kind of range right here-ish. I mean, just from a technical perspective, that would appear to be, what's kind of unfolding. And rates just couldn't go down any further. Every single thing, talk about the kitchen sink, every single thing got thrown to make rates go lower. And now some of those things are being reeled back, so we're getting a move higher. I've told you my prediction for this year is that we're going to get up to here, about 6.5%. I do still expect that, but it may not happen overnight. I think this is a good range for us to expect to be in, which means rates could go a little bit higher. And I think we'll see that they will go higher. 4.42 is not what it's going to be after we get last week's data in on Thursday. I think you're going to see probably 4.6 to 4.7. If we look at, sorry, I'm a little disorganized here. Oops. My bad. So if we look at this one, mortgage rates soar closer to 5%. A second huge jump this week. This is from Friday. And, they're saying here, well, according to Mortgage News Daily, the average 30-year fixed rate was 4.95%. And that's just Mortgage News Daily. That's not all of mortgage data. So, we don't know what actual rates people are getting. But one of the things that's interesting is you don't know if people are paying points. That's not factored into this. So like if the average rate really is 4.95, but people are paying points because they just can't stomach it and they're getting 4.5, 4.5 is what gets factored into the average. So that's something to keep in mind. So this is an article I put in here just so you can kind of get some of this data from Mortgage News Daily. They're talking about rates moving and some different stuff in there that's reasonably worth watching. So then if we go back here, I'm going to be kind of all over the place today because there's so much to cover and I don't have a ton of time to do it in. So, in my opinion, we probably go in this range for a little while and we kind of things get their worst. We're up to around there and that'll be that. I hope that's right. We could get back into this range up here. This is also a possibility. We could see that we get back into this trading range, which is previously established. That's totally possible. But who knows? Nobody knows. We're all just guessing here. Trying to make educated guesses, trying to prepare people, trying to prepare ourselves for what's next. Now, if we also take a look down here in the bottom portion of the screen, this is really interesting because this is the kind of data that really on its own doesn't mean much. Like 7.08, this doesn't really mean anything. That number doesn't mean anything unless you compare it to itself from the past. So sometimes data, like this, you look at it and you go, what's the use of this? Well, it's useful to compare it to itself. And there's a couple of things that I found that were interesting here. Now, right now, as you can see, we are currently at an all-time high for home price to median income ratio, which means how much of the median income is the average home price. And so if the median income, for example, is $50,000 and the average home price is $350,000, then you have a factor of 7. So it's essentially how many years of your annual salary, gross, before taxes, does it take for you to buy a house? In this case, we're saying it's 7x. And that's kind of the highest it's been. It is the highest it's been. So at least going back to the 80s, is much, much lower before. This has been steadily increasing over the years. And now it's kind of gotten to a point where it's very, very high. But if you actually chart this out, I don't have the best drawing tools here on preview, but I'm going to do my best. You can kind of see, that ain't going to do it, is it? Will this? You can kind of see what's going on here. And there's basically this channel that's going on, and it's going up. Right, it's going up. That is probably one of the better. It looks just like the Bitcoin chart. It's except for on the Bitcoin chart, we're right here. So when you look at this, you go, okay, well, it's gonna take. Home values are just simply going to become a bigger cost with respect to what you make per year. That's what this chart is telling you. And that is a macro situation. When I talk about macro implications in our homebuyer seminars, when I talk about macro implications of real estate long-term, this is what I mean. It's like gravity is just pulling the prices higher. There's nothing you can do to stop it. Now, it will fluctuate from time to time, unlike gravity, but there is overall a magnetism towards prices going higher. And that's what this is showing us. Now, also, if we have lower household incomes, that can also affect this. If we have higher household incomes, that can also affect this, obviously. But this is something that's been going up a lot recently, a lot. And that's because real estate values have gone up a lot. So it makes sense, right? We have other things that are sort of factoring into this too, or into the overall cost situation and the recession fears that we're hearing. So let's talk about that real quick because, all right, we're willing to acknowledge that right now it costs more to buy a home with respect to the median income than it ever has. We have a spike in mortgage rates, although rates here you can see we're still very low on the sheet. I mean, this is going back to the 80s, and look how low we are. We're right here on the whole chart. I mean, the chart goes up. We have data tracked up here on the chart. So, we're still in the low range, the lowest range of it, but, rates have gone up. So, okay, those are facts. Let's take a look at, all right, mortgage rates. Now, the 5-year and 30-year Treasury yields have inverted for the first time since 2006, and they're saying this is fueling recession fears. And anytime you have yield curve inversions, it is something that causes pause. And the easiest way to explain this is that the outlook becomes so bad long-term that long-term bonds don't yield any more than short-term bonds. So why would anyone buy a 30-year bond for 2% if you could buy a 5-year bond for 2%, et cetera? This is just the assumption that, things are going to get bad, basically. And so, this isn't the major one. The major benchmark that's used for this is the 2-year and the 10-year. and that is still not inverted. But the 5-year and the 30-year, this hasn't happened since 2006, which was, a couple years before the recession. And recessions do, like I said, these indicators, they come up years ahead of time. So you don't really know. You don't get that instant gratification. You have to kind of watch things unfold, because it's not necessarily guaranteed that there will be a recession, although we're kind of due, or a little bit overdue for one maybe. But there's no guarantee that that'll happen. And if this is correct again, it's 2-3 years from now. So how do you play that? How do you play something that might be a bad thing that's 2 or 3 years out? That's tough to sort of figure out, isn't it? So what are you going to do? I'm going to sell my house now. And then do what? And when are you going to buy back in? What are you going to do? Okay, it's 2-3 years before we have a recession. Then it's 2-3 years before prices correct. And then, so it's 6 years down the road. And then what? It just gets difficult. Even if you're right. Now, what if you're wrong? Then you're really caught holding the bag. I mean, that is brutal. Brutal. So it just becomes difficult to manage these things. And that's why I think like having a long-term outlook is really good and really important, because if you have a long-term outlook, if you're not trying to trade your house, if you're not trying to trade your job like a stock and so forth, then maybe these things don't mean as much. Maybe it doesn't really matter. I think this is worth noting, just because this is a pretty liberal outlet. Job approval rating for the president, lowest point of presidency. Most Americans think the U.S. is heading in the wrong direction. You think? I don't know how that could be any more obvious. It's so obvious that it's actually being printed here on CNBC. I'm sure everyone is already aware and has their own opinion, but it's really, really shameful. Let's see. We talked about that. Home sales. Pending home sales sink in February, setting a grim tone. Okay. Pending home sales. These numbers, are they super crucial to help understand what's going on? Not exactly, but it's just another piece, right? There's certain seasons and certain situations in which these numbers can be off, but not really mean anything. And heading into the busy season, the spring season, is one of them. So I don't take this for more than face value yet, because I haven't seen anything on the ground floor yet. And by the way, if we're going to see things change on the housing landscape, we'll see it on the ground floor first. The only thing we've seen so far is rates have gone up and some buyers have exited stage left, and they have become a part of the rental side of the real estate demand. That's one thing that I think everyone should understand, that there's a zero-sum game. If you are renting or if you are buying, you are part of the demand in real estate. It's a matter of whether you have a demand for something that a landlord has, or you have demand for something that a home seller has. Either way, you need housing, and either way, you're participating in the housing market. Right now, so those people who've exited stage left, they've gone to the rental market. I have not seen any of them come back and go, we can't rent a place either. I think it might be easier to buy. I haven't seen that happen. So maybe they are having luck with rentals. I'm not sure, but we know rents have definitely started going higher, and they're going to skyrocket this year, and that's one of the reasons why. This I just thought was crazy interesting. 57% of U.S. households paid no federal income tax last year. Just bananas. And the Cold War, that is sort of, the stuff that's happening with Russia is basically setting up a new Cold War. It's a new financial war, economic weapons. You can't have a real war, because at the end we both blow everybody up and probably blow up the whole planet. And nobody wants that, thankfully, or so it seems. So we're going to start to see some of these things, which will weigh on the economy, which will weigh on prices, will weigh on the supply chain. So how do we sort of add that all up? Well, we have rates spiking a little bit here, but still in a good long-term position overall. I mean, this is a very good place to be right here. If we can stay inside of that, that'd be great. I'm happy to be wrong about 6.5% for the year. I would love to be wrong about it, actually. But I just kind of think that's ultimately where it's headed. So hopefully I'm wrong. The median, the home price, the average home price to median income ratio number, you can see it's gone straight up, but it's starting to bend a little bit. What will we see happen next with that? Will that come back down into a lower part of this range? That's possible. That's possible, right? I mean, that could happen. That would tell us that either incomes are going up or home prices are going down. Either way would help bring that metric in. It's probably more likely for us to see home prices go down if this is to go down. It also doesn't have to go down. So we kind of have a couple pressures there. We have the inverted yield curve between the 5-year and the 30, which was a great indicator of the 2008 recession, the Great Recession. We have interest rates popping up, but nothing super crazy going there. The data on the street is not crazy yet. So I think recession fears, not that they're overblown. I think it's totally reasonable for us to have this conversation. It's totally reasonable for us to think about this. But I also think that if you start letting things like that dictate what you do too quickly, you can make a very long-term mistake over short-term information. So when you receive information that is short-term information, in other words, it's based on a short time frame, but you make long-term decisions based on short-term information, that can really lead to just bad decisions. That's really what, can just lead to big mistakes. So we don't know what the catalyst will be for more inventory or lower rates. I certainly can't tell you I see either one of those happening, but I can tell you that things are probably not as bad as they seem. I posted something today, actually. I should have probably pulled that up. Too late now. Just talking about what is the difference in price. So like if you're buying a house or you're refinancing a house and the interest rate goes up 0.25%, how much does that affect your payment? It's about $75. Okay, it's about $75 a month for every 0.25% in interest rate. And this holds true for most price points. Obviously, it's a little bit less than that on lower price points, a little bit more than that on higher price points, but about $75. So if rates from the beginning of the year have gone up 1.5%, which is what I expect, we'll get the data on Thursday from the Fed. They will say that rates are probably in the 4.678 range, somewhere in there. We started the year off at 3.11, so about 1.5% more. So that adds up to, let's see, if it's every 25, so 25 basis points, 20.25%, and we've got 6 of those. And so 6 times, so that's 150, so $450. So $450 a month in purchasing power that has sort of been taken away. Now, what does that add up to? So about $450 a month on your pre-approval. If your payment is going to go up $450 a month, that's going to be about $100,000, somewhere between 90 and 100,000 in reduction in purchasing power. So if you were pre-approved for 800,000, and now you have a rate that's yielding you $450 more a month in payment, then you're going to be pre-approved for about 90 or 100,000 less. That's what it really boils down to. So there is a reduction in purchase power. That is real because of rates going up. Will those buyers still buy? Or will they rent? Will they wait? Will they buy something that's a lower price point where the market hasn't really moved? So for buyers, their purchasing power has decreased $100,000, here in the first couple months of the year, first 3 months of the year, but home prices haven't gone down at all. So what's going to happen there? Does something have to give, or is there enough demand that the market can handle? It sure seems like there's enough demand in the market, but we'll see. I also included in the description my most recent national TV spot. We're talking about inflation and just some of the things people can expect from the Fed and so forth on there. It's always fun. The Rumble link for that. Today, just mortgage bond wise, real quick. Just a terrible looking candle. One of the weakest candles. You can't even hardly see it. Look at this thing. Do you see? Oh, I got to get out of the way. Just one of the things. Like, look at this candle. Is it even a candle? It looks just kind of like a wick all by itself. There's nothing great happening there. Support is holding. Let's just say, okay, hey, support is holding. So we'll try to make chicken salad out of, you know what? That's not a bounce. That's hanging on for dear life is what that is. So yeah, recommend very highly to lock rates today. I know it sucks. I know Friday stunk. Rates have gotten worse, but there's pretty much one direction that this thing's going to go. And it's not good. But we know that, right? We're already aware of that. We've seen the downtrend. I've drawn this all before. You know where this is headed. You can see the channel. It's very thin and very direct, headed lower. May have gotten ahead of ourselves a little bit here, so maybe we bounce back into this thing and then continue. But there's no bullish catalyst for mortgage bonds, or any bond for that matter. And I was going to talk about bonds today a lot. I have a bunch of stuff on bonds that I pulled over the weekend, but I'm not going to do it. But I'm not going to bore you with that. This isn't a bond channel. But the bottom line is, there's nothing to be excited about on the mortgage rate front as far as things getting better anytime soon. And the candle that we're getting today is maybe the worst candle we could have got. I mean, other than just flat out dumping, the worst green candle we could get would be this one. Just super, super weak. It's so small you can't even see it. We zoom in. It's just nothing. It's a nothing candle, although we're up 2 basis points. It's just a nothing candle. So those usually aren't met with like big, huge rallies the following day. Lock your loans today, team. Lock them up. Lock them up.
Check, please.
Okay, last thing here. We'll pull rates tomorrow. Basically the same as they were last time we pulled, so we'll pull rates tomorrow. So Bitcoin here. Remember when I was saying how the other chart just looks exactly like the Bitcoin chart? Look at this, the M, sort of the McDonald's M. And then this one here kind of has the same thing, right? Except for on the Bitcoin chart, we're like right here. And you can see this big M going on. And we have the macro channel, which is bracketed with the green. And then the current up channel, which is bracketed here in red. And we did bounce off of the top end of that earlier. This is the daily chart. But you can see there's a lot of strength here. There's a lot of really interesting things happening in the Bitcoin world. And I just continue to be so insanely bullish long-term over this thing. Insanely bullish. If we look at what happened in the markets today, pretty much green across the board. Nice, solid day in the stock market, right? Bonds moved a little bit. Oil down. Oil did bounce off 115. I was kind of saying 112. It bounced off 115. Has come in. This is also something that we're looking at as a signal for a recession. I forgot to mention this earlier. When oil spikes like it did, it spiked up to 130. Every time we've seen a spike like that in oil, just sort of an uncalled for huge spike in oil prices, almost always follows a recession at some point in the next 1 to 2 years. So that's another indicator that we've had fire off. Gold back down near 1900. And then, just looking at the cryptos have been crushing. Ethereum has been on a huge run. Bitcoin has been on a huge run. XRP getting back up, marching its way back up to $1. That lawsuit should be settled by mid-year. And that could be huge. And that may be what the pump is about. I'm not really sure. You never know. But that lawsuit that XRP Ripple has with the SEC should provide a lot of clarity on how these cryptos, the non-Bitcoin cryptos, will be treated moving forward. It could be a super bullish situation. It seems to me, based on what I've seen and what I've heard about it, that Ripple has the SEC by the legal tootsies. They've got them. Like, they've got a guaranteed win. And so the expectation is that the SEC, instead of allowing them to win, is going to try to offer some form of settlement, and that should be coming in the next couple months. We'll see. That could have a big impact on what's going on here. But notice Bitcoin, Ethereum leading. This is not the alt season everyone's talking about, where these are going to be up 3-4% and the alts are going to be up 9-10%. Haven't seen that. There's been a few breakouts, but for the most part, pretty much just Bitcoin leading the way, Ethereum as well. Bitcoin is now a positive for the year, which took a few months. It was in the doldrums there for a minute. And I think for mass adoption, we can expect more, just for the sake of Wall Street getting on board and bringing clients to this, we can expect to see sort of more slower, steadier gains in Bitcoin, as that will draw more and more people to it. All right, that's it for today, guys. Hope it helps. Remember, if you ever want to get a direct rate quote, all I need is loan amount, the purchase price if you're buying a home, home value if you're refinancing, your approximate credit score, and whether it's a condo or detached. Email me, text me, anytime. Here to help. Want to help make sure you get a great deal. Help make sure you get great information. Want to help make sure you don't pay unnecessary fees. That's what I'm here for. That's what I do. That's what I'm living. That is my passion, my focus, and my mission. So help me help you. Have a great day, guys. I'll see you soon.